As you can see, I am running. Not to reach anywhere, but to maintain my position. If I stand still, I'm going to... Yes, you guessed it. Fall. Come to think of it, that is exactly what inflation does to your money. If your money is stationary, inflation will derail it from its position. A 100-rupee note yesterday will not be worth a 100-rupee note a year later. What I mean is, it will continue to be a 100-rupee note, but okay. Let me explain it with an example. Remember your Nani telling you stories about how they would buy a toffee for a naya paisa or watch a movie at a grand price of 25 paisa? A 100-rupee note in Nani's times must have been a king's ransom. Today, a bag of popcorn at multiplex costs more than that. So why has the value of the 100-rupee note degraded? Yes, the culprit is inflation. We all have heard of and know about inflation. So, what is inflation? Simply put, inflation means that your money will not buy as much tomorrow as it can today. A fall in the purchasing power of money. The key question now is, what can we do to cope with inflation? Are you saying savings? No, my dear friend. Inflation mange more. You need to go one step ahead and invest your savings. The difference between savings and investment is that savings means just that you save your money. Investment means a deliberate, informed decision to park your savings into various assets to not only save your money, but also to add to it. Now, what are these assets which will add to your money? We have come a long way from the traditional investment which was limited to land and gold. Today, through the mutual fund route, the menu of investment choices is diverse and dynamic. They are so diverse that you will be spoiled for choice, and so dynamic that they are designed to suit your personality. Are you a conservative investor? Then debt funds could be your choice of investment. A debt fund has the potential to provide a steady but low income relative to equity. It is comparatively less volatile than equity. You have an appetite for risk? Equities will satiate your appetite. Equity funds have the potential to offer a high rate of return if you stay invested over a longer duration. You want to be daring but also want a protective cushion? Then balanced funds. Debt and equity is the one to pick. If the sheen of gold is your choice, then gold ETFs and gold funds, which are backed by corresponding units of physical gold, is for you. And Sone Pe Suhaga. If you are a thali lover, you could spread your investments into a whole gamut of avenues by investing through mutual funds. The menu is exhaustive. You can choose depending on your taste and need. Of course, we need to assess the various investment options prudently before making a choice. However, as we've been taught since a young age, nothing ventured, nothing gained. And to beat the monster of inflation, investments can be an efficient weapon of choice. So go on and invest through mutual funds. Try and beat that inflation and keep running. It's good for your health, and as we all know, health is wealth. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.